I guess, guys. Welcome to another live trading clinic. Today we're going to focus on the Bank of England. Again, is it important? Is it not important? It's certainly important for forward, guidance. It's certainly important for looking what's going to happen in the markets in the future. Very interesting kind of political situation now. So we're trying to balance out these economic conditions that we're experiencing, and we're trying to then balance out what the next government, is trying to do to retain power or to get in power. I think the main thing that worries me about interest rates is that we were either in a growth or inflationary stance when we come to looking, as traders at economic figures. So we've been in growth for a long time. So really concentrating on the GDP figures, employment figures, and we're moving into this inflationary cycle only because interest rates now are a little bit more important than growth. So it's the will they, won't they raise interest rates. We all know, of course, interest rates have to go up. It's inevitability. But the problem is that we've kept interest rates artificially low, and we've, pumped the world full of, quantitative easing money. So we don't really know what a normalized inflation rate is. The inflation rate has just been kind of left to do whatever it's done. It hasn't really been controlled in the right way. So the problem is now is how do we start setting our stall out for the next kind of 3, 6, 12 months when interest rates become, more of an inevitability. Now, a lot of people are saying interest rates won't rise before the election. I can see the arguments for that. But we've pretty much got, not set in stone, but the market started to price in that interest rates are going to move third quarter in the US. So whenever the US moves, the UK, is going to do the same. And I think the UK, saying that it's got the strongest growth figures of any G8 economy, has to be in the position to lead by example. We've got this really, kind of strange mix-up between the emerging markets of, good news, bad news out of China, Japan. It's kind of always bad news and a little bit of good news. The Eurozone, there's never been any good news. There's never been any good news out the Eurozone. And I've been saying this in my webinars for over 2-3 years now. Mario Draghi is the only one with negative deposit rates, talking about now bringing in quantitative easing. And the guy's a lunatic. And the Eurozone, nothing good will come of it. It just is doomed to failure. So we've got the Eurozone, not having a clue what it's doing. We've got China, Japan, the emerging markets, India, that we don't know what they're doing. We just simply don't know what they're doing. We've got the US that seems to be back on track. Stop the quantitative easing, doing the right thing, seems to be growing slowly, but still growing. Then we've got the UK that seems to be standing on its own, a little bit head and shoulders above the rest in terms of growth, but then a complete contradiction in terms. We still need to cut the budget more, but we're going to spend even more on spending. And all the kind of figures that come through the UK, again, concern me. The unemployment rate is way down, but that's because people are getting zero, rate contracts and very low paid work. So actually, with the thresholds for tax changing, it doesn't make any change to the situation at all. The benefit system obviously has been cut, and we're still looking to reform that. But you still have to think. I mean, it's just common sense. If you've got a growing welfare state, it doesn't matter how much money they get or don't get. These are still people using the NHS, public services, not putting anything back in. So as that continues to grow, and it will continue to grow, there's no doubt about that, then obviously it's going to get more expensive to fund over time. Then we're doing other things like bringing in the mansion tax. Who cares? If you can afford a £1 million house, £2 million house, and you get taxed 15%, I don't care. I'm not going to lose any sleep. As I've said over the years, I've got very wealthy clients. I've got billionaire clients, and they're not going to be bothered. They don't care. They buy these houses, they don't even live in them. So what's another 15% to them? Absolutely irrelevant. But the real thing, the kind of inroads the UK have made, I guess, from the budget yesterday, is talking about getting some more tax off the banks and businesses. And that's where it should come from. You can't have companies operating in the UK and then using again legal tax systems to get their money outside of the UK and not pay tax. It just isn't right. We own the banks, so of course we should tax the banks. So this is just another windfall tax, to be honest. It's not really going to again change anything, but it'll bring some more money back in and redress the balance between the rich and the poor. So we're in this situation now when we focus on what's going to be said in today's Bank of England announcement, and it's fairly likely it's going to be unchanged. But it's not about the figure today. I mean, we get a shock probably once every 5, 6, 7 years. I don't think today is going to be that day. But it doesn't mean we won't see movement in the markets. Now, again, when traders listen, to what kind of, is said, the comments that are made afterwards and the little bit of movement and noise, people are positioning themselves. Trading's, a complicated game. People are involved for minutes, sometimes seconds, and then hours, days, weeks, months, years. So there's all different spectrums of people that will be listening to what's being said today, and it will have an effect. I've said that the UK will be first to move on rates, and I did say that'd be the first quarter of 2015. I'm going to stick by it. I can't really be wrong now, to be honest. It's going to be first or second quarter, maybe just after the election, but it's going to happen, and it's going to happen in the UK before it happens in the US, and certainly, before the Eurozone. So there we go. I mean, it's what you think is going to happen. I mean, the main point I would say is that when interest rates go up, this is a true test of how an economy is doing. I was very worried by, not worried, I concur less, but when I was listening to the Scottish referendum vote, one of the key points was that 1 in 4 people in Scotland couldn't afford a £50 raise to their mortgage rates. So if they did split and mortgage rates went up, 1 in 4 people couldn't afford their mortgage. Okay, so that's why I was fairly confident that the no vote would prevail there. But then if you factor them figures outside into the UK, how many people are absolutely maxed up to the eyeballs on credit card debt, personal loans, and mortgages? So even a quarter or 0.5% rise over the next couple of years could really cripple people's ability to pay down debt. And we know there's a lot of it. There's more personal debt than there's ever been, and people aren't paying it down. So what really is going to happen? This is a real test of the economy to see what does happen when interest rates finally have to go up. And unfortunately, there's no good news. The only good news is if you aren't debted up to the eyeballs, you're probably going to get some bargain houses. So again, it's very, very difficult to see the outcome, and that's why we've skated around the issue. Mark Carney's skated around this for a long time. Carney's not stupid. He knows that interest rates have to go up. It's cyclical. There's nothing he can do. He can keep them artificially low, and we can control them. But it's a part of nature, part of life, part of the cycle of economics that interest rates will have to rise and normalise. And we're looking at 0.5%. 5% is generally normalised, or maybe 4% in these new kind of crazy economic times. But whatever it is, money will never be as cheap as it is right now. So only way is down, I'm afraid. Up for interest rates, down for borrowing. So before I start, as always, the risk warning. Remember that spread betting, CFD trading carry a high level of risk or capital, resulting in losses that need judicial deposit. They may be suitable for all investors, so please understand the risk involved. The information comments provided here in no circumstances consider an offer to invest. Nothing here should be construed investment or tax advice. The information is accurate. The data is produced. So education only. Content webinars, personal opinion of the moderator, not trade.com. Content is not constitute financial investment or tax advice. Trade.com does not accept any liability to the content consumed during the session. So I'm going to go over the usual things, guys. Live charting analysis, multiple time frame trading. It's just the way I trade. Fundamental analysis is what. Then I've got the account open, so I will do a trade. I'm going to focus on cable, the FTSE, and gold today. Then Q&A, guys. If you want to talk to me about anything fundamental or technical, let me know. I mean, these are meant to be open charting sessions. Anything that you want to know, we can go through. There's nothing you can ask me that I won't have an opinion on or answer to. Doesn't always mean I'm right. I'm not here to be that person. I'm just here to tell you, my opinions, how I see the markets, how I see the world. Is there around? Okay. That's probably one question I can't answer because I don't actually understand it. So if we're looking at the charts right now, we can see we've got an interesting setup. We're still slightly bearish in the in cable, so the pound against the dollar. So let's say if you look at these monthlies, we were looking at this point here in the charts. I'll just again make it very, very clear and show you that when we're doing some technical analysis in previous sessions, you can see that key 50% wasn't hit. So we had all this time, around 164.430 to bounce back up, retest that 50% and go on to try and make new highs. I did think that was going to happen. And again, it hasn't. And I don't know whether this is because this is more the institutional style traders taking their profit from, these early trades, anticipating, back in 2009, 2010 and 11, that, the interest rates are going to rise first in the UK. So taking the profit up here. And then when everybody knows interest rates are going to go up, then forcing the value of the pound down. Or maybe there's just a natural correction. I would say I'd rather have my money in pounds than euros, and the dollar is still the world's currency. It doesn't matter if people think the renminbi is coming back or whatever. It doesn't matter. Everything's priced in dollars, commodity wise, for a reason, because it is the strongest economy in the world. And it might not be the biggest on paper, but when you look at the GDP per head of China versus the US, it's $4,500 in China, $44,000 in the US. The US still has the biggest, most powerful, aggressive army in the world. it sounds archaic, but again, who are you going to bet against? You know, if it came down to it, I'd be on the side of the Americans. Do I worry about, Iran, China, of course. But, if it comes down to it and pushing that button and, standing up to the world, it's going to be America that does it. So you might as well, be with the devil you know. So we can see that we've got this 23.6 level down here in the fibs, which is going to be a natural target. So 1.52963 is where we could see a potential bounce. And if we see a break of this, then again, we're going to get back to these lows that we saw back in November 2008, and the market's going to continue this downtrend. So a really key pivotal point. But we've seen 1, 2, 3, 4, 5 selling months. So we drew a bounce at some point, aren't we? So what we do is we need to take this view through the charts. So take it through to the weeklies so we can see again how the market's reacted. It's tried to, find a little bit of support the kind of third time around on this 38.2. But it's a technical move because look how support becomes resistance. When the market finally rejects support, it acts as resistance. Okay, so that's a technical move just here. And the market's moving down. So we haven't got far to go. We've only got, 270 ticks or so before this key level down here. So bring that to your daily charts. And again, you can see how the daily charts have seemed to bottom out. If you want to bring some colour to this, put some Bollinger Bands on. You can start to see how the Bollinger Bands are contracting. So again, it isn't difficult to see the trend. You just draw it here. So if the trend is down and the Bollinger Bands are quite close together and continue to hit this line here, then you could see a sharp break down to 152 and below. Okay, so you're trying to build a picture of what the monthly's telling you through to the weeklies, dailies, and then finally to your hourlies. Again, you can see how the market is a bit more of a steeper, downward movement. So again, you're looking for maybe, I guess, a triangle style trade where the market is, losing momentum here, okay, making lower highs, lower highs, lower highs. So you're waiting for the market to consolidate. As it gets down to here, it can't break up, it's going to break down. Then you know where your level is. Down here, okay? So that's your risk reward. You can set, your kind of risk up here. So you've got 90 ticks for a stop versus, 400 ticks on the way down. So that's not a bad trade at all. So you can take your profit anywhere within here. But it depends if you think the pound's going to continue to weaken against the dollar. So just put the my kind of Fibonacci style view on. It's not right. Okay. So again, going back to the charts, we can see that realistically, this 50% on the hourlies is acting as perfect support and resistance, and the fibs are so important, guys. So we can see we've topped out here. Yeah, technical move. Again, tried to close above it, can't. Technical, so it's looking weak. So we've got, plenty of downward levels. If we see some negative comments out of the BoE today. So we could see, 28 ticks down to this level here, 70 ticks down to here, and the final 423.6, full extension of the hourly Fibonacci is 139 ticks down. So again, you've got good sell points, you've got good targets, and that's how you need to build your charts up. So anything that's, bearish or hawkish out of the Bank of England today could see the pound to continue to fall. So we've got the UK 100, the FTSE. I still am amazed the FTSE hasn't hit 7,000. Because, the S&P's held above 2,000, the DAX has continually hit 10,000 and above. All the major markets in the world, have hit technical and psychological levels. I just can't believe that the FTSE hasn't. You look at the monthlies, again, put it on a blank chart. We're all saying that, a few months back, that's it, the world's finished, we're going to have this massive crash. We didn't. What we had is a technical, institutional grade sell-off. So the markets went down here and knew this was the level the market would find support on the monthlies, broke through it, but again, completely rejected it. So if you're looking for a longer term picture, I just cannot see how the FTSE won't get to 7,000. If it doesn't get to 7,000, I'll stop trading because I won't understand the world. Okay, so we've rejected that strong move down. The Fibonacci's, again, you can take them from anywhere you want, but I would say the strong directional move started here to the highs. So again, we got right down to that 50%. Okay, time and time again, your Fibonacci's are absolutely crucial. So you're trying to tell me you can't technical trade? Of course you can. Yeah, that is a strong directional move. Yeah, from a low to a high. Yeah, the market then aggressively pushes the market down, breaks this trend to the 50%, can't close within it within the month. Next month open greens. Then again, what have you got? You got this now to act as support. You got the 23.6 to act as monthly support. You've got this trend line, and you've got the 7,000 just here. Tantalisingly close. The rest of the world markets, have made their psychological highs. The FTSE is still a world-leading market. It has to go and target 7,000. Simple as that. Okay, I don't know what else it can do. If that's not telling and screaming to you that market wants to get to 7,000 with this trend that you can see here, I don't know what is. Look on the weeklies. Again, you see a different style of picture, but it's still very strong. Support. Big doji, green weeks. Consolidation. Might see a little bit of a move down here, but probably not, I would say. I would say, again, we're going to see in the next few weeks, just gradually, then we aim for that 7,000. What happens above that? I've absolutely no idea. Maybe the markets will tank. Maybe they won't. I don't think we're going to see a major correction until probably late second quarter of next year. And it's going to come. Okay, don't get me wrong, it is going to come. There's going to be a major correction in the stock markets because people are going to finally get jitters. But the reason why stock markets are so high is because where else would you put your money? What would you do? Would you buy Greek shares or Greek debt or Google shares? Yeah, countries are struggling, okay? They're struggling to offload debt. They're struggling to get people to buy into them. Companies aren't. Google market cap is at 700 billion. It's going to sell more products by this time until Christmas than it did in 2014. It's on track to being the first trillion-dollar company. So where would you put your money if you were a rich investor and you weren't worried about, the normal bills and the day-to-day things most people are? Well, you put it in where you think it's safe, with big technological giants. Big pharmaceutical companies. We're an aging population. All we're going to do is require more care, keeping people living longer than they should. Okay, all these things, are going to be on the cards, aren't they? Again, I don't want to be like Nostradamus here, but you can see how the world's going to get. There's only finite resources. The next one they're talking about, it's not won't be enough water in the world. 2/3 of the planet's water, and you can do desalination, so I can't see that. But, it's expensive. And it'll come down to, who wants it? Who wants it and who can get it and who can pay for it? The world's not changed. We haven't changed as human beings since cavemen. We still want, the nicest cave, the prettiest cave woman and all that kind of stuff. But it hasn't really changed throughout history, has it? We still want, the nicest, semi-detached house, detached house, townhouse. We want the nicest car. We want the nice holidays. We all want stuff. We're driven. We're pre-programmed to consume that makes us happy. And that's not going to change. And then you start to develop, nations like China. And there's billions of these people. So if you tell China that the way to be happy is to buy stuff, and, there's billions of Chinese and they get money, what are they going to do? That's right, buy stuff. So we all keep buying stuff, that need shipping, that need oil, that need, all these kind of different ingredients. And there's only a finite amount of it on the planet. And as we keep growing, faster and faster, living longer and longer, consuming more and more, something's going to tip. So a little bit more in depth at them comments today. That's a bit of a bit of a future snippet into the latest book I'm writing. And it's again, it's about there's nothing new in the world. I mean, it's basically we look to the left in the charts to predict the future. So this is about life. Look to the left in life to predict the future. There's nothing we don't know ourselves. That we're going to be surprised. It's not like we're going to invent a pill that cures cancer tomorrow. It's not like we're going to all find spirituality. In the next kind of few years. The reason why people exist together because it's that absolutely impossible balance between everyone getting what they want and everybody being satisfied with their lot. And it's that fine knife edge way of existence, and we're all just controlled by the same way. It's either by money, by fear, or by greed. There's no real kind of new things to bring to the mix, I'm afraid. But anyway, back to the FTSE. Again, 7,000 just looks at an absolutely inevitable target for me, and I would be very, very surprised if we don't, get to that level. It might only be 7,000, for a day or two. That might be the all-time highs, and we might come down from there. But I would just be absolutely amazed if we don't now have rejected this move down, get back to these upper levels. So my old friend gold. So gold's always a good one to look at because it's it's a measure, a store of wealth. We had a massive bit of information from Switzerland by not putting 20% of their reserves into gold. Now, this is why trading so difficult, because we all know the rules of the game. We all know what should happen, but generally it doesn't. The opposite happens. So this is when the Switzerland says no, this gap down. So we see this move down here. So no, yeah, okay, that's the end of gold. Gold's going to get to $1,000 because Swiss are not going to be bidding the market for the next 10 years, buying every low in gold. What happens? Bang! Market goes aggressively up to these highs to squeeze out any potential shorts. So it's probably now taking this window here of all this movement up to you know 1 2 1 6 really, okay, which is pushed up to the highs. So what it's going to spend its time doing now is getting back to these lows and hitting $1,000, because there's now nothing to keep gold up. If the Swiss aren't going to come in and prop the market up, then gold was on a downtrend anyway, so it's going to go down. And I've said, in the FT in September 2013, that gold would get to $1,000 by the end of the year. Unlikely it will now, but it's going to be close to $1,000 than it is, 1,300 or 1,400 or 1,500 or certainly 1,900 where it's been. So again, just go back to the monthlies, and we can just see how we're building this technical view. Highs to the lows once again. That 50%, there we go. It's acted as a nice support. So we've just touched below this 61.8 and had a little bit of a rebound, maybe due to the fundamentals, maybe due to the final, gold bulls, remaining, a little bit positive. But realistically, again, we get and close back below 170.7, then we're going to hit these lows down here, and then we can complete the Fibonacci, which is again a long way away, and gold could easily get down to $700. But your $1,000 for me is another big psychological target, and it's not a million miles away now. So see how these Fibonacci. So again, I wouldn't be buying to the 50%, but I'd be selling the 50%, down to these lower levels. And again, see how the Fibonacci's worked. It's this significant low back in 2009, this significant high. If we're going to make new highs in gold, that's fine. But, we've got all these levels to go. We've got all these levels to hit and test. We've only really got one level on the downside, which is that $1,000. So anything's possible. We've seen that, the size of these, these monthly candles. So, gold, if it wanted to, could easily sell off to $1,000 in a month, easily. So again, move through your weekly. Still looks pretty negative to me. Higher, low, lower high, lower high, lower high. So the weeklies still look fairly negative to me. We've seen this kind of Swiss intervention, vote, speculation. But again, we'll give it its dues. Rejection here. So the market, does want to move higher, technically speaking, on the weeklies. But really, my long-term view of gold is that it just has lost its value. It's lost its place in the world. So again, that 50%, we're acting as support. So short term, you would expect the market to try and get back to 1255.38 and maybe above. But again, I'd be selling into these highs here and letting the market go back to that $1,000 rather than buying into these levels here. Again, people can say, well, if gold's going to go up in the short term, why not buy it? I don't want to, so I don't. So, if you make, 450 ticks potentially buying it here, but I wouldn't. I'd ignore gold until it gets to these levels and look for sells. It's just the way I view the markets, and that's what you got to stick to. You got to stick to what you believe or what makes you money. So technically speaking, on the dailies here, that 50% has acted as support, so we could see some upward movements. On the hourlies, again, you could even do yourself another Fibonacci. Just take these off. So to understand that the market really has gained a lot of strength here and got back. So again, look at the Fibonacci's are acting as support. So we haven't got as low as the 50%. So that's still telling me that on the hourlies, if we don't get to that 50% and start to tick higher, then we're certainly, going to make them new highs. So you'd look for that daily level, which I said before, which are the previous highs, to be a point of interest. Okay, so just put that on your hourly chart. So that's there. So you need the next point of interest, which will be probably here. So again, that's higher time frame trading. Seeing what is important on the higher time frames, using your smaller time frames to trade. So there we go. The market holds above this 50% here and gets nowhere near it. The more it ticks up higher, the more it's going to target 1221 and then get to 1238. And again, I'd be happy to sell these levels up here. But again, if you're a gold bull, this move is telling us if it continues to have more bulls than bears, in this move and all this time here, it's going to go higher before it goes lower. So there we go. That's pretty much the major three markets that I'd focus on right now for this announcement. So we're going for unchanged, but it's more what the comments are going to come out. It's more the kind of speculation, what's going to be said, you know, with regards to forward guidance or any kind of snippets, any kind of wobbles from Mark Carney from the Bank of England. Again, inflation, I don't think is a true measure of what we're trying to achieve with interest rates. I think it's more weighting and a bit of a political slant, to keep people with any kind of money in the pockets, and then the government can get re-elected, or Labour can come back in, or the new coalition come back in, and then whatever happens. But what's inevitable, guys, is interest rates in the UK are going up in 2015. First quarter, second quarter, third or fourth, does not matter. When you get a mortgage, you get it for 25 years. Okay, most of my kind of peers are getting mortgages for 35 years. So interest rates now are absolutely irrelevant. Absolutely relevant. But in 5-10 years, let's hope you're doing better, because interest rates will be significantly higher than they are now. Think back to the 80s. Interest rates when people were buying houses were 14%. Then you could buy a 3-bedroom semi for 50p or something. So, it's not the same world we're living in. So it's not the same conditions. The world's speeding up, and it's a lot more complex, a lot more complicated. All right, guys. Well, anything you'd like to ask? Carlos is just saying, interesting take on the world economy, Steve. It is true that our lives are intertwined with this predatory economy. It's been the dominant narrative in history in the world. Do you foresee GBP trading 1.48 sometime next year? Yeah, I think very astute, Carlos. Again, there's probably nothing that I know that the majority of you guys don't know. I think sometimes we get absorbed in our lives and we just get on with it. We think that we don't have any control over the political system, and so therefore we just get on with it. But it's funny how over the last 5-10 years, how more people now talk about finance and talk about interest rates and talk about things because they affect their lives, whereas that wasn't really kind of commonplace 20-30 years ago. People just got a mortgage, paid it no matter what, and just got on with it. But life expectancy, things have just changed. People view houses as investment vehicles, as pensions. So my kind of big bone with houses is if you treat them as investments, they act like investments. If you don't treat them as places to live and treat them as investments, then you're opening them up to be something else. So all these buy-to-let, all these things happening, could certainly, quickly unravel. I would say because interest rates are going to go up, Carlos, I would say that I would not expect to be getting as low as 1.48. Look at the monthlies. I think the institutions are digging into these long-term views. So I'm going to expect to see a big bounce up, I would say. I don't see... Obviously, interest rates, when they go up, it's seen as bad for the economy, but it's good for outside investment. So if you have your money in dollars, euros, yen or whatever, you would come and put it into the UK to benefit from that safe interest rate, that higher interest rate. So I would say that maybe we bottom out around about 150, maybe 148, these lows down here. But if we don't get to this low here, a 1.36, then we may get to 1.48 for a short amount of time, but that'd be just buying. The whole point is I'd be looking to buy now, to be honest. If we close green for this month, then we're going back up. It's as simple as that, because we've got to dig back and take some profit, short or long term, from this down move. And as we move into the UK, even though it's slow growth, low growth, it's still growth. So I just still think the UK is a massive tool for the world economy to kind of pump money into. So I can only see the pound going back up, to be honest. So yeah, we might get down as low as 148. It is a good technical level, but I'd say if we don't get down to that kind of level before Christmas and we hold these low levels here, then I don't think we're getting back for some time, because into first, second quarter of next year, we're going to see interest rates back on the agenda, and certainly going to happen, and it's going to have to pull the pound up. So I think this institutional getting all the longs out here, getting long all the way down the range here, and then pushing it back up and getting above, probably back to 180 by the end of next year. So higher GBP for me for certain. All right, guys. Well, just a minute now actually before the Bank of England. So again, the call. I'm not going to make any call. I'm just going to tell you what the figures are, and then we'll trade accordingly if there is any short-term opportunities. No problem, Carlos. Good question. Very insightful question, that. Okay, so just waiting for this announcement. We're expecting unchanged. Unchanged, guys. So let's listen for any comments, anything out of the media. Okay, we're not expecting anything. There's no press release open to the public. So let's just see if there's any particular movement, in the main markets. We're just kind of mid-range towards the lower bowls with two rejections in the GBP. Gold has done absolutely nothing. Again, seeing this downward formation. But as I said, if we don't break the lower bowls, we could easily drag ourselves back up to 210 on the short term, back to that 50%. FTSE again, I'm just looking for opportunities to buy. And, again, lots of indecision here, but it looks to be pushing up higher. So, yeah, again, with the unchanged figure today, not really a lot of kind of comments flying around. I think we're stuck in this difficult position now where it's become more political than economic. We know it's inevitable interest rates go up, and it doesn't really matter when, does it? It's as I've explained for them, different reasons that people get mortgages for 25 years, 35 years. The UK is not going anywhere. So the fact that interest rates will go up sometime in 2015, it is going to happen. So, yeah. Okay, guys. Well, like I said, I mean, I'm sticking with the Bank of England and the Fed because we're moving out of the growth figures. We're moving out of the growth into the inflationary stance, and that's why these meetings are going to be much more important in 2015 than the big growth figures. GDP is going to be fairly irrelevant, I would say, probably for the next kind of couple of years because it's expected to be pretty much stagnant in the UK and US. So non-farm payrolls will still be a big one. Any kind of sentiment figures will still be looked at by the market, but it'll all be focusing on now in the future on these Bank of England interest rates announcements. And remember, once they go up, they're not going back down. So every cycle we'll be looking for unchanged or growth, hike, a rate hike. We're not going to ever see, well, not ever, but we won't see any cuts for the foreseeable future because these things, again, are cyclical. So we've held interest rates artificially low for 7 years. We might then go on a hiking cycle and do it every quarter or every couple of months and have a break. But, interest rates might go up to 5% over the next 5 years, over the next 2 years. Steve, a penny for your thoughts on Mario Draghi. Well, we'll give you a penny worth of thoughts. We could, for each one of them, we could be for some time. I had high hopes for Mario Draghi. Someone that came from Goldman Sachs, a company used to making money. I think with Mario Draghi, what disappoints me the most is that he's trying to please the world markets. He's trying to appease people in power rather than helping the people of the European Union. He has been last to the party with everything. While the market was cutting rates and, pumping quantitative easing in years and years ago, he didn't. So now he's last to the party. So while the UK and US the US has stopped quantitative easing, the UK is talking about stopping quantitative easing and putting up interest rates, both respectively, kind of Q2, Q3. Mario Draghi's still got negative deposit rates. He's talking about cutting interest rates further and now talking about quantitative easing. Well, I don't know about you, but I know for a fact Germany doesn't have as much money as the US. So how can they sustain the European Union? Okay, I lived in Spain for 8 years, so I know how Spain works. I know how Europe works. They have great, massive infrastructure, but they spent all the money. What they don't have is the inward investment, and they don't have the inward infrastructure to support inward business to support that infrastructure. So more loans to failing countries just means they fail, but at a slower rate. Greece now has more debt than when the crisis started. Okay, but again, people have jobs, more jobs than they did, but they don't mean the better jobs, better quality jobs. You have to look at Greece as a prime example. People had ghost jobs. People worked for the state, okay, in air quotes, and never actually went and got paid for that job off the state. It was a national pastime, when they put a tax on swimming pools to hide your swimming pool so the government couldn't see it. So these people have raped their own countries by not paying taxes for years and years. If you go to anywhere like Italy and you ask a Sicilian, are they Italian? No, I'm Sicilian. Okay, well, if you're not an Italian in Italy, then how can you be a European citizen? You've got all these big countries, very, very disgruntled by their own political power. And now they're, again, have to adhere to Europe. So you've got the mainstay of Germany, and Angela Merkel saying, we'll do whatever it takes. Well, sorry, Angela, you can't cash them checks. You can't bank them. Who do you think you are? Literally, who do you think you are? You're going to sustain the European Union just on your own. It's absolutely nonsense. So my thoughts on Draghi are that he's out of ideas. He's never had any ideas. All he's done is copy what has happened in the US and UK and done it later on with less effect. So I wouldn't be surprised if the euro splits into north and south, and I'd give it 2 or 3 years, to be honest. And Mario Draghi is going to be the man to blame for this. If he'd have been more focused on helping people feel part of a union and feel like things were getting better, tackling youth unemployment, tackling people that are going to be around for the future, and doing positive steps, to help actual real people, rather than, again, trying to keep the debt rating up, trying to keep, the credit rating, and trying to prove to, the UK, the G8 countries that, the European Union's strong. It's the third biggest economy in the world, and Mario Draghi has been absolutely instrumental in battering it to death. So I think the guy is an absolute joke. And he had every opportunity from his background to come in and to shake things up and do things the right way. And he just hasn't. So I would say that's probably about a pound's worth of comment there, Alexander. But I'd say that the guy is probably the worst thing to happen to Europe since, Europe became Europe. I think it's disgraceful that he's still there. If he was a football manager, he'd have been fired 10 times over. Yeah? But we seem to be sticking with him. But no new ideas, and the longer rates stay negative, and the longer they do these things, the more stress the banks are going to come under, and the more we're heading for another financial crisis. And you know what? There's the money to bail them out. Yeah, the UK aren't going to do it. America aren't going to do it. Russia, unfortunately, they might have done it, but no money anymore. Bye bye, Russia. So, to be honest, it's just inevitable doom for Europe. The euro is going to continue to slide. It's going to split into north and south. And, I wouldn't be surprised if Greece, well, the pigs, I think Ireland will be fine. But, Portugal, Italy, Greece and Spain, I wouldn't be surprised if they all go back to native currency. I wouldn't be surprised if Spain go back to the peseta. Wouldn't be surprised at all. Big, two fingers up to the rest of the world. Get back to your tourism, get back to making things cheap. Don't know if you've been to Spain anytime, recently, but it's damn expensive. So I would say that there's nothing good coming out of the Eurozone. There's nothing good coming out of Draghi. I give him another 6 to 12 months in the job before the European Union have to find somebody else, because it isn't working. And there's no magic fix. But good question. Thank you for allowing me that self-indulgent rant. What's your thoughts on Mario Draghi? Alexander, does anybody have any thoughts on Mario Draghi? Anybody thoughts on Mark Carney or Janet Yellen, for that matter? Do we know of? Do we think these guys are doing a good job? Yeah, I mean, I can see your point, Carlos. I think that the trouble is, going back to my point about people, is that people are one of the most difficult things to control. I mean, you've seen it throughout history. You've seen the Romans, you've seen England versus Scotland. You've got the conflict in the Middle East. People are very, very difficult to control. So if you've got older generations, understanding how times are better, they've only seen things, get good, over the years, and Spain, things got better than they joined the EU, and bang, prosperity for everybody. But unfortunately, the same generation has taken all that money. So the same generation has taken all the money from the boom, okay, in property, in wages, in good conditions. So they've got it all, and they're not giving it to the other generations below. So the other generations below are just left with the crap. They're left with the debt, the uncertainty, and they haven't seen this growth. So, again, if you were 20 years old 20, 30 years ago, you could get a normal job, you could get a house, you can get on the ladder, and you can feel like you're getting somewhere. If you're a 20-year-old now, you thinking that the average house price in the UK is about 280,000 quid, and you've got a job for an apprenticeship, with McDonald's for £16,000 a year, you can't afford a house because you can't put the deposit down, you can't afford the mortgages, you can't afford the house full stop. So what have you got to live for? You're not going to live through that boom. I mean, the next boom will come probably in about 25, 30 years, where the generation above die and leave all the houses and property, and then the kids that have never had this stuff will just sell it. So there'll be more money in the economy and people just going out spending it because they've never had it. Because mummy and daddy, who've had their house for 30 years, they bought it for 17 grand, back in 1965, and it's now worth 280 grand. When they get that money inherited, they're going to spend it. Okay, maybe on houses, maybe on other stuff. If you've never been on the cycle and you've only ever rented and never aspired to own your own house, then the whole thing, again, especially in the UK, breaks down. We say in the UK that your home is your castle, but if we're building a generation now, generations to come that never can aspire to have a house, then why would they? So if that dream goes and then the future generations don't buy houses, then the whole house of cards collapses. Yeah. The whole point is managing expectations. You cannot have 1% of the population with 50% of the wealth. And these are the people that are paying the least tax. I mean, again, it's all proportional. I'm not saying they don't pay tax. I'm not saying it's not huge amounts. But, if you're a billionaire and you're paying, your tax on your corporation and your personal stuff, it's nothing compared to the squeezed middle, is it? Yeah, there's more people out there with more money these days than there ever has been. Due to quantitative easing, the expansion of the financial markets. Rich people are just richer. The gap between the rich and the poor, and I'm talking between the poor and the rich, but also the middle, working class type and the poor. There's people that live off nothing, literally, $1 a day type stuff. And then there's people that are poor in Western terms, but still have a plasma telly and have Sky and have a house and access to medical care. So that's not really poor, is it? So it's redressing this balance between what we think is poor and what's not. I mean, kids these days, parents think they're poor because they can't buy the kid an Xbox or an Xbox and some, £100 pair of trainers. That's not poor. It's just managing expectations. I would say the problem with the EU, just going back to your point, Carlos, it's just it was put together in a different time, in a different generation. The world's moved on. And the idea of the EU is good. It's economies of scale, it's unity. But if you don't have the unity, you don't have anything. And if you don't have a leader, you don't have anything. Europe is too big, too complex, and too volatile. Okay, and you've got countries like Germany, Finland, kind of Germany, France, putting more in relative terms than the taking out. There's only so long that can ever last for. You can't make German people work, save, and act like Greek people. It's just too complex and too big to control. That's my problem with the EU, and that will not change, because you're not going to change people. And the longer it goes on, the more disgruntled the next generation become, and the older generation die out, then the more they'd vote for to go back to the way it was. I mean, look at government. Look at anything. It's just history. We have a Labour government for 10 years, and then it's like, oh, well, things were not that good under Labour. They were okay, now they're rubbish. Let's have Conservative. Well, okay, 5-7 years of Conservative. Well, that's rubbish now. I don't want that. I want Labour back. It's just cycles. My argument is, what should we do? As a population of people are getting older and living longer, do we make politics longer, make them more accountable? So if you come into power, do you have 10 years? But then you have KPIs, and you have to say, I'm going to do this in the next 10 years, and you have to do it, or you boot it out. Or, as we're a more fast-moving economy and a fast-moving, kind of race of people, do we keep it shorter? You've only got 18 months rolling in the government, so you've got to do things now. You can't say in 5 years, in 10 years, do it now. Come into power, do it, or you're out. What do we do? Because the current system isn't working. All we're doing is listening to question time and Prime Minister's questions. Same old bollocks. We inherited this debt, so we're doing better. Ah, ha, ha. And then the next question is, well, what's going to happen in the next 7 years? I don't know. Won't be in power. What are you going to do? Back and forth, back and forth, back and forth. Constant bitching. So we need to change something about that, make people accountable. Because that's not what we're not doing. And we don't see any accountability for anything when it comes to a European level or a government level. We don't see anybody actually getting fired or getting a slap on the wrist. I mean, maybe, Ben Bernanke should be in prison for, taking the biggest calculated gamble in the world, about $1 trillion. Yeah, if that goes wrong, yeah, he's going to lose the world economy, trillions and trillions of dollars. So, what was he doing? The best he could? He's just a man at the end of the day. He doesn't know the future. He can, he's an intelligent guy, but he can't predict the future. He doesn't have a crystal ball, does he? Yeah, of course. Yeah, we can look at the Aussie dollar. Yeah, okay, guys. Sorry, we're just coming towards the end of my time now. Let me just quickly go through the Aussie dollar. Aussie dollar's going down for me. Again, all you have to do is do the Fibonacci. Start the move back in November and 8. So you look for that 50%. 50% here, we're going below. So I think the lower targets are certainly 0.81145, and then below. Australia again is just like everyone else. It was the boom place, had nothing but 100 years of boom, but it's stagnating. Its trade partners are more, the kind of the other side of the world, China, Japan, etc. They're struggling. Aussie will struggle. So boom and bust, boom and bust. So I'd say below that, yeah, these lows here could be targeting, but it's going lower. Aussie dollar's going lower for sure. All right, guys. Well, thanks a lot, guys. Cheers for your questions. Cheers to Carl especially. Thanks to Dino and the guys at FX Street. Okay, well, I'll be around for another couple of presentations this until 2015, and hope you enjoyed it. All right, guys. Speak to you all very soon. Have a good afternoon.